Yeah, so imagine a time traveling investment wizard that would tell you what a stock would be worth in 1 year. Well, actually, let's get to him later. For starters, let's get a little bit of context. Pre-tax savings are likely way better than most people realize, and this video will hopefully help you realize why I think that's the case. Just as a super fast introduction to what I'm talking about, pre-tax, as the name implies, means before paying taxes. So if you're getting a pay stub from an employer, you would put money into those pre-tax contributions before the government would take them out for taxes. The question is, who cares? I just said the word pre-tax and half the audience got more glazed over their eyes than a cop's fingers while eating donuts. When using pre-tax contributions, it means that your overall tax burden goes down. A lower tax burden means you basically get more money because you spend less. When people talk about trying to have more money, typically they are looking for ways to obtain more rather than retain more. However, if the pursuit is an attempt to simply have more in general, then the two are quite similar. Take an extremely simple example of someone getting $100. They can make two choices. Either they can get a $10 bonus and must pay a processing fee, or they stay at $100 and don't have to pay the processing fee. This seems like a dumb choice because in the end the result is the same, and that's the point I'm trying to make. Whether you're getting extra money or saving money that you would have spent anyways, it's all the same. Thus, pre-tax contributions, which lower your tax burden, increases how much you retain, which means having more money and increasing your returns. You might think something along the lines of, sure, but is it really that much? So again, imagine a time-traveling investment wizard that would tell you what a stock would be worth in 1 year. He has a very cool ability to tell you the price of a stock exactly 1 year in the future. You have 3 tickers that you give him and see what will happen. After rubbing his head, he tells you what percent increase each one gets each year. Quadruple A gets a negative 5% return. Quadruple B gets an 8% return. And quadruple C gets a 25% return. So obviously you put every dollar of your life savings in quadruple C because there's no way a wizard would lie to you and you want 25% returns. After 1 year, you actually do make 25% returns, and of course you're happy because those are amazing yearly returns. You sell the stock, take out your capital gains tax, and of course you're back to the wizard because there's no way it was just a lucky guess. Now, as absurd as that sounds in a situation that never could possibly exist in real life, there is a situation similar to this which is so boring that people don't pay attention to it. And that's pre-tax savings. Let's use a really simple number so I don't make any math mistakes. A person gets $1,000 from their paycheck every week and gets taxed from that paycheck at a rate of 25%. That means that their net pay, after the government yoinks out $250, is $750 net. Now let's say that some nut job has the same pay rate of $1,000 a week, but instead contributes 50% of their paycheck to pre-tax savings. Now that net pay goes from 1,000 times 0.75 to 500, because that's taken out first, to the 500 plus 500 times 0.75, assuming this person's still in the same tax bracket. Now that person instead has a net pay of $875. So how exactly is pre-tax savings similar to the stock picking wizard? Let's remember back to our small flowchart of how saving and earning essentially gets you the same place with obtaining more money. On the one hand, you could earn a lot more by picking absurdly good stocks and getting great returns that way, or you could save more money by choosing pre-tax contributions. But the wild part is that it's actually better for pre-tax than a regular 25% return. And why is that? Because to go from $750 to $1,000 requires approximately a 33% return. By choosing pre-tax and depositing $1,000, you now have $1,000 instead of what would have been $750. So just by choosing to use pre-tax, even without choosing stocks or bonds to invest in, you increase your returns by about 33% compared to not doing it. For reference, an average S&P return is anywhere from 6 to 10% depending on what years you look at. Amazing returns, like from Peter Lynch, managed to get approximately 29% yearly returns. So compare that to the 33 estimated percent return that we would get just by choosing pre-tax contributions. So being able to easily increase your wealth by utilizing pre-tax accounts seems very useful, especially with the comparative returns that it's giving you by how much wealth you retain. But you don't just put money in these accounts. Then, after putting money in the accounts, you also, on top of that, get to invest them. Let's say somebody originally gets paid $10,000 before taxes get taken out. Now, for a person using pre-tax contributions, they would have added a whole $10,000 into something like a 401k. For somebody who is adding to an account after taxes are taken out, let's say 25% in taxes get taken out to keep things consistent, they would only contribute $7,500 to a normal account. After compounding for 40 years, what difference does that really make? For the person putting in $10,000 pre-tax after 40 years at 7% growth, that person gets about $150,000, whereas for somebody putting in only $7,500 because he chose post-tax using the same time and growth rate at 40 years and 7% growth, that person only gets about $112,000. And that's a difference of around $37,000 for just 1 year's contribution. As mentioned previously, that was just the difference in 1 year's contribution for only $10,000. Now imagine the difference between the two if it happened every year. What could that look like? Well, there's no use wondering. I did the math for you so you could see, and with this, I'll stay at the same $10,000 that they want to add each year, and it's the same 7% growth rate. Here's the summation of those calculations. At the end of it all, person A, who utilized pre-tax, would have a little more than $2.1 million, whereas person B, who was using post-tax money and was only able to contribute $7,500, would have a little more than $1.6 million. That would be a total difference of a little more than $500,000. And this difference was caused by how much they were able to add pre-tax compared to adding it afterwards when taxes were already taken out. As always, consult a tax expert if you have questions about how to maximize your savings and best courses of actions to take. This was just an introduction to showcase how pre-tax contributions are likely better than most people thought and isn't specific investment advice to your situation. Thanks so much for watching. Subscribe and hit the like if you enjoyed.